just dive right into this. Welcome to this Iron Financial Explainer. I'm your lead analyst, and honestly, my mission today is incredibly simple. We are here to cut straight through the market noise, strip away all that shiny corporate PR spin, and help you forge a stronger, much more resilient portfolio. Today, we are literally putting on our hard hats and doing a massive, comprehensive financial teardown of the Home Depot's Q2 2026 earnings report. And look, you need to understand right up front, this isn't just about a company selling 2x4s and power tools. Home Depot is a massive, load-bearing bellwether for the entire U.S. economy. We are going to strictly inspect the fundamentals of this retail giant. We're going to look under the hood at the core engine. We're going to stress test the balance sheet's durability, and we're going to see exactly how management is allocating capital in what is undeniably a turbulent economic environment. Right, and I'm your market skeptic. While my partner here absolutely loves to geek out over the raw, unyielding numbers, I'm the one swinging the sledgehammer. I represent you, the retail investor listening right now. I'm here to cynically probe this overarching narrative and ask the undeniably tough questions. Because let's face it, in a high-rate macroeconomic environment where capital is just punishingly expensive, we need absolute concrete proof behind every single corporate claim. So before we start pouring the concrete on today's analysis, make sure you hit that subscribe button and ring the bell so you never ever miss an Iron Financial teardown. So the central thesis we absolutely have to address today is this. Is Home Depot a bulletproof cornerstone blue chip stock, or are we starting to see structural cracks forming beneath the surface? Because we cannot just look at this company in a vacuum. Just look out the window at the broader economic landscape right now. We have a stubbornly stagnant housing market, elevated mortgage rates that just flat out refuse to cool down, and a tapped out consumer base that is dealing with some serious, undeniable renovation fatigue. Consumers are actively, aggressively putting off large debt finance remodeling projects. We're talking about those major kitchen overhauls and massive bathroom expansions. So I have to aggressively ask the question, is this company structurally sound enough to actually weather the storm, or is it starting to groan under the weight of a weakening, inflation-weary consumer?
And that's exactly why we don't rely on gut feelings or market panic around here. We rely on the blueprint. We are going to stress test those exact macro concerns against the actual audited Q2 filings.
So here is our blueprint for today's teardown. First, we'll look at top-line price versus volume. Second, margin-heavy lifting. Third, the pro ecosystem. Fourth, stress testing that debt. Fifth, our macro stress test. And finally, the verdict. Let's start laying down the bricks. Section 1, top-line analysis, looking at price versus volume. Let's inspect the revenue bricks they laid this quarter and see if they actually meet structural code. So the crucial point is sitting right here in the hard data. Home Depot reported a massive, staggering $47.9 billion in Q2 net sales. Just let that number sink in for a second. That is a 5.7% year-over-year revenue beat, representing an absolute real dollar increase of $2.6 billion from the second quarter of fiscal 2025. This solidly, decisively exceeded Wall Street consensus, which, let's be honest, was pricing in a much bleaker quarter for retail overall. If we zoom out and look at the first 6 months of 2026 combined, net sales reached $89.6 billion, which is up 5.3%. Total company-wide comparable sales increased by 1.7%, and U.S. comparable sales were up 1.3%. Let's put this into some real perspective. For a company of this sheer, massive scale, operating in a historically tough housing market where homeowners are essentially locked in place, pulling off a nearly $48 billion quarter is a monumental feat. It proves, without a doubt, that the core engine is still generating serious, heavy-duty horsepower despite the nasty macro weather outside. Okay, hold your horses right there. Let me grab the sledgehammer for a second. Because when you actually stress test this revenue, a very different picture starts emerging. Look at the massive divergence in the underlying metrics. Yes, the comparable average ticket size went up 2.8% to $92.50, so you are charging people more at the register. But comparable customer transactions, meaning actual physical foot traffic in the stores, declined by 1.0%. And listen, this isn't some isolated incident. Back in Q1, we saw transactions drop by 1.3%, so this is a continuing, highly concerning trend. Total customer transactions actually fell from 446.8 million last year to 443.2 million this quarter. You literally lost over 3 million transactions. So I have to ask, is this 1.7% comparable sales growth real, structural growth, or is it just a mirage? Are we literally just looking at price inflation and bigger shopping baskets masking a steady, undeniable decline in actual consumer engagement? Because to me, relying heavily on price hikes while fewer and fewer people actually walk through the front doors looks like a serious foundation crack. You can only raise prices so much before the consumer completely breaks. Look, I hear the skepticism regarding foot traffic. It's a fair point. But let's move to the bottom line and see how this builds out because profit is where the structural integrity of any business is truly tested. Even with that 1% dip in traffic, the bottom line durability here is totally unquestionable. Net earnings were $4.8 billion. Diluted earnings per share came in at a rock-solid $4.79, and that's up 4.6% from $4.58 a year ago. And if you look at adjusted diluted EPS, just to account for some one-time items, it was $4.92, up from $4.68 in the prior year quarter. So while foot traffic might be slightly down, the profitability of the transactions they are actually processing is significantly higher. The operational engine is highly efficient at turning those $92.50 tickets into bottom-line shareholder value. They aren't just blindly passing on inflation. They are capturing real margin. All right, Section 2, efficiency review and margin heavy lifting. We really need to scrutinize if supply chain headaches or ballooning labor costs are starting to eat into the foundation. Because like I said, you can't just raise prices forever to cover up operational bloat. Eventually, those inefficiencies will absolutely collapse the structure. Now, if you read the 2026 proxy statement, management absolutely loves to show off this corporate values wheel. They talk endlessly about taking care of our people and maintaining an entrepreneurial spirit. And hey, it sounds great in a marketing brochure or a fancy corporate retreat, but we have to look at the cold, hard financial reality of those statements. They explicitly stated they made significant investments in wages and benefits, heavily increasing equity awards to field leadership and store managers. On top of that, they just integrated massive, incredibly complex acquisitions like SRS Distribution and GMS. As a skeptic, I have to drill into this. Is this whole taking care of our people mantra just PR fluff, masking rapidly ballooning operating expenses? Are these massive permanent increases in labor costs secretly dragging down the whole structure? Because labor is incredibly sticky. You cannot easily roll those costs back if revenues suddenly drop off a cliff next year. Well, let's just tear into the actual operating expenses to answer that, because the data paints a picture of immense operational control. Yes, selling general and administrative expenses, or SG&A, did indeed grow. SG&A hit $8.4 billion this quarter, which is an 8.5% increase from the $7.7 billion we saw last year. And that fully accounts for those wage increases and the massive SRS integration. However, you have to look at the gross profit line above it. Gross profit came in at $16.1 billion, up 6.5%. Because of strictly disciplined execution, incredibly tight supply chain management, and really smart pricing strategies, management actually executed some heavy lifting on the margin side. They expanded gross margins to 33.7%, up from 33.4% a year ago. I need you to understand, expanding gross margin by 30 basis points in a highly inflationary environment is an absolute masterclass in retail execution. Even after paying that much higher SG&A and dealing with a massive SRS integration, they still delivered $6.8 billion in operating income, which is a 4.3% increase. That is the exact textbook definition of operational leverage. They are successfully absorbing higher internal costs without letting the foundation crumble even an inch. Moving to Section 3, strategic pillars, specifically the pro ecosystem. Let's evaluate exactly how professional contractors are carrying the weight compared to traditional DIY customers, and how broader macro trends are shaping this segment. Let's dive right into the core macro strategy drivers keeping this whole engine running. Right now, we currently have millions of U.S. homeowners locked into 6.5% mortgages. They have absolutely incredible equity sitting in their current homes, but they absolutely can't afford to move and take on a brand new loan at current rates. So what happens? They're forcefully embracing the renovation versus moving trend. Now, while large, debt-financed remodels, think those $50,000 kitchen overhauls, are definitely down due to high borrowing costs, these locked-in homeowners are aggressively funding the small project cycle. They're painting, they're upgrading fixtures, and they're doing basic maintenance. And on the professional side, Home Depot's massive acquisition of SRS Distribution, which itself had previously acquired GMS, is a total game changer. It rapidly accelerates their vision of becoming the undisputed leading multi-category building materials distributor for the pros.
Yeah, look, I don't disagree on the small project cycle. The numbers definitely back that up for now. But I am intensely, closely watching those SRS integration costs. Sure, SRS gives them over 1,200 new branch locations, a huge fleet of delivery trucks, and massive exposure to the highly complex professional contractor market. But integrating a logistical beast of that sheer size is a remarkably heavy lift. If the housing market gets even slightly weaker, relying on pros who in turn rely on large-scale new builds could really backfire. Professional contractors are always the first to feel a true recession. Renovation fatigue is a real, creeping risk if the broader economy finally tips over.
All right, Section 4, balance sheet check. Stress testing debt. It is high time to see if this company is dangerously over-leveraged in a high-rate environment. We need to know for sure if the underlying structure can actually support the immense weight of its own liabilities.
And honestly, here is exactly where I sound the alarm. If you look at the August 2nd balance sheet, Home Depot is carrying a massive, staggering $44.0 billion in long-term debt. And you have to realize that is strictly the long-term portion. That entirely excludes the $4.6 billion in current installments and another $4.2 billion in short-term debt. When you add it all up, total liabilities sit at $92.8 billion against total assets of $109.3 billion. Guys, we are living in an era where the cost of capital is just incredibly punishing. Refinancing any of that debt in the current interest rate environment is going to be incredibly painfully expensive. Carrying $44 billion in long-term debt aggressively challenges the structural integrity of this entire company. Are they highly vulnerable to a sudden liquidity crunch if consumer discretionary spending just falls off a cliff?
Well, I look at that exact same debt load and I see a rock-solid foundation, because you have to look at their ability to service that debt through pure cash flow and smart capital allocation. In the first half of 2026 alone, Home Depot generated a massive $11.4 billion in net cash provided by operating activities. Let me just repeat that, $11.4 billion in pure, unadulterated cash flow in just 6 months. That easily, and I mean comfortably, covers their debt obligations and their interest expenses. Furthermore, look at their highly disciplined capital allocation principles explicitly laid out by management. Priority number 1, reinvest in the business. This is backed up by $3.7 billion in capital expenditures recently, ensuring their supply chain and their stores remain absolutely top tier. Priority number 2, the dividend. They have paid a cash dividend for 156 consecutive quarters. They returned $9.2 billion to shareholders in fiscal 2025 alone. That is an absolute cornerstone for income investors. And priority number 3, share repurchases, returning excess cash to shrink the float. Their 5-year total shareholder return is an incredibly impressive 56.3%. You simply do not achieve those metrics or maintain a massive dividend for 156 quarters straight if your balance sheet is crumbling. The debt is just a tool, and it is easily serviced by massive, highly predictable operating cash flows. Section 5, forward guidance, our macro stress test. We are going to strictly test the reaffirmed full-year outlook against the harsh economic headwinds currently battering the retail sector. Can the foundation actually hold through the end of the year? I want to highlight this direct quote from CFO Richard McPhail during the earnings call. He noted, "Our second quarter results exceeded our expectations. We saw broad-based demand across the business as customers continued to engage in smaller projects. To me, this proves incredible, enduring consumer resilience. Even with immense, crushing pressure on big-ticket items and a totally frozen housing turnover market, the core consumer is still spending heavily on necessary maintenance, repair, and smaller aesthetic upgrades."
Yeah, I will definitely push back hard on that rosy interpretation, because management also explicitly cited ongoing consumer uncertainty and a structurally weak U.S. housing market as primary reasons for the slowdown in transaction volume we discussed earlier. High interest rates are actively, visibly causing consumers to delay or completely scale back large, highly profitable discretionary remodeling projects. Yes, sure, small projects are keeping the lights on right now, but let's be real, you can only sell so many cans of paint, bags of mulch, and hand tools. If unemployment ticks up even slightly, or inflation bites even harder into basic groceries, even that reliable small project cycle will face severe, heavy pressure.
Despite those very real macro headwinds you just mentioned, management remained confident enough to establish precise, load-bearing metrics they fully expect to hit. They officially reaffirmed their 2026 guidance, signaling heavily to Wall Street that the ship is completely steady. They project total sales growth between 2.5% and 4.5%. They expect comparable sales to be anywhere from flat to up 2.0%. They are heavily targeting an adjusted operating margin of right about 12.8% to 13%. And finally, adjusted diluted EPS growth of flat to 4.0%. They even factored in expected IPIA tariff refunds to help offset unplanned fuel and energy costs, showing really meticulous planning. And interestingly, if housing activity actually shows unexpected momentum later in the year, they have fully modeled an accelerated recovery case where total sales could realistically grow 5 to 6%. Make absolutely no mistake, the structure is standing tall and properly reinforced straight through the end of the fiscal year. All right, Section 6, the verdict, a blueprint for investors.
We've stress-tested the debt, we've scrutinized the margins, and we've intensely debated the foot traffic. Now I'm challenging you for the ultimate takeaway here. Is Home Depot a cornerstone blue-chip buy to firmly anchor a portfolio, a cautious hold and watch the cracks, or downright dangerous value trap just waiting to collapse under macro pressure? Here is the decisive, absolutely no-nonsense blueprint for investors looking at this stock. Home Depot has definitively proven it has an incredibly durable operational engine. Generating nearly $48 billion in a single quarter, with heavily restricted housing mobility, is a massive testament to their scale, their logistics, and their raw execution. The foundation is solid. But going into next quarter, here are the strictly defined key levels you must actively monitor. Number 1. Transaction volume recovery. We need to see if that negative 1.0% traffic drop starts reversing or if consumer fatigue is deepening. Number 2. Pro sales versus DIY mix. Watch very closely how well the massive SRS acquisition actually translates to top-line integrated pro revenue. Number 3. Margin defense. Can management maintain that highly impressive 33.7% gross margin against steadily rising SG&A and sticky labor costs? And number 4. Housing market lock-in duration. As long as rates stay elevated, the small project remodel cycle remains the absolute load-bearing pillar of this stock's revenue. Overall, the financial foundation is absolutely intact and generating immense cash, but the macro weather outside is severe, and it requires strict vigilance. And that wraps up our exhaustive Q2 2026 Home Depot teardown. As you look at your own holdings and your own capital allocation strategy, I want to leave you with this final, truly provocative thought. Are you actively building a truly resilient portfolio capable of withstanding this high-rate inflationary macroeconomic environment? Or are you dangerously ignoring the structural cracks forming in the broader economy? Don't let slick corporate spin dictate your hard-earned capital allocation. You have to do the heavy lifting. Drill down into the raw numbers. Thanks for joining us on this explainer. Be sure to subscribe, and we'll see you on the next teardown, right here on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.